Well, thank you very much. We're going to continue this afternoon's session with a panel discussion on mine supply. But firstly, before going into that, Grace has just introduced our participants today, but perhaps you'd each like to say something a little bit more and talk about the organisations you're representing. Michelle.
Sure, thank you. Good afternoon, everybody. My name is Michelle Taylor, and I'm the Chief Operating Officer of Tharisa. I've been involved with Tharisa since 2008 when we were a greenfields project, an exploration project with very little. And we developed Tharisa from that exploration project to today being a sustainable, large-scale, open-pit mine environment, where we produce some 5.6 million tons of reef, together with 1.7 million tons of chrome concentrates, as well as 160,000 ounces of PGMs.
Hi, I'm Henk de Hoop, CEO of SW Oxford. We've been analyzing the PGM markets for the last 20 years plus. A lot of our clients are either in the supplying industry, so the mines. We also have clients on the end consuming side, OEMs, and a lot of clients in the middle as well that process PGMs, recycle PGMs. We provide market analysis and price forecasting, but we do also quite a bit of consulting in the industry.
Good afternoon, everyone. My name is Adrian Hammond. I'm an analyst covering the platinum sector for SPG Securities. SPG Securities is a wholly owned equities business of Standard Bank. Standard Bank is the largest bank in Africa. We serve our institutional and retail clients in research and trading, covering 17 African markets. We cover over 160 companies, and we currently share 17% of all trades on the JSE today. We are the largest shareholder in that trading business. We are about 25 analysts, 7 salespeople located in Johannesburg, Cape Town, Lagos, Nairobi, London, New York, and Beijing. I'm also proud to say we are the #1 research house according to the FM survey for 7 years running. And today is a very special day because they will announce the 48th result this afternoon. So let's see what happens, fingers crossed.
Excellent, thank you. So let's get the discussion started, and I've got some questions to begin with. So Henk, I'm going to start with you, please. Could you provide the audience with an overview of the global PGM mining industry with a particular focus to resource scarcity and the challenges facing maintaining supply since it peaked around the middle of the 2000s?
Yeah, thanks. And it's quite, I think it would be helpful if I had the slides back behind me, because we talked about that. But important to reiterate, South Africa is absolutely dominant. We've had the Russians producing quite a few PGMs as well as a byproduct, and it's an important differentiator. Their mines run on nickel and copper prices and have quite a significant contribution from PGMs, particularly the palladium side. But they are not as economically challenged as quickly as the PGM miners would be if the palladium price or one of the other metals comes down. We are pure PGM miners with minor byproducts. They are major base metal producers with minor PGM byproducts. There's been a lot of work done over the years in trying to find PGMs across the world, and the only successful ones were probably in North America, where we have the Stillwater mine, where we have the North American palladium operations, and there's a couple of nickel operations that have PGMs as a byproduct. Again, a byproduct, but in minor quantities. They will never start a mine in those regions or based on those ore bodies, based on PGM prices. It will always be driven by the nickel or copper economics. There are some deposits in Australia, there are some deposits in South America as well. Very few will change, and none will actually change the overall dynamics of the supply side, in our view. So the supply side will be driven by South Africa and Zimbabwe, and to a lesser extent, Russia. But the concentration of these metals in the hands of so few is a very unique feature of the PGM markets.
Thank you. And then, Michelle, just moving on to you. Obviously, Henk's just discussed some of the pressures being faced by mine supply. Tharisa's largely been going in the other direction. How does Tharisa set itself apart from the peer group, especially with regards to the dual commodity aspect and the importance of chrome to sustaining your output?
Sure, thanks, Ed. I think that's a really good question. You know, back in 2008, when we were exploring and understanding the mineralogy of the mine that we were planning to develop, our chairman at the time said to us, it is critical that you extract all the minerals and all the metals that you can from the ore that you mine. And so with that philosophy, we then undertook to plan the development of our mine as well as the processing plants to be able to extract chrome and to extract PGMs. Because at that time, I think if we were an only chrome miner or an only PGM miner, most would have said, we're crazy, why would you do that? It's a low-grade deposit. But the very nature of Tharisa being a co-producing model enables us to be at the lowest cost quartile. And that sees us through difficult times of price volatility. I would like the stars to align at some point and have chrome concentrate prices and PGM prices soaring at the same time, and that would really be good. But for now, we certainly are able to sustain ourselves through it because of the philosophy that we adopted and the way in which we process. So when we extract our commodities, we process and extract chrome first, then we will extract PGMs, and then we'll extract chrome again. And then we have a third run at it, and we extract chrome from the live tailings. All of that enabling us to subdue and hold our costs at a low level.
Thank you. And I should note that I visited Tharisa in 2007 when it was just a sort of empty bush plus a few test pits. Adrian, moving on to you for our next question. From your perspective as an equity analyst focusing on the listed PGM miners, how would you characterize the impact of falling metal prices, and what has that impact been on the profitability of the mining companies? And what options do they have to insulate themselves to further declines in either the commodity price or strengthening of the rand?
So to be frank, I think it's been quite devastating, the impact. So far, more than 50% of the cost curve is underwater. Most of the companies are hemorrhaging cash at the moment, some more than others. 2 of the 4 producers have balance sheets that are okay. The other 2 are in quite a severe situation, and one of those is actually in a very dire situation with concerns around the balance sheet that may obviously flow into concerns around the sustainability of their portfolio. But, you know, these companies are all operating in South Africa, but they're very different. And what's interesting to note that there's about 4 drivers that you only really need to understand why there's this difference in the profitability. One is your position on the cost curve, and that's obviously a function of geology and mining method mainly. Then CapEx cycle. Some companies elect to be counter-cyclical, and so that some are doing better than others right now, because at the end of the day, it's a management decision. And certainly some companies today are harvesting assets, haven't been spending any CapEx. So, in fact, that is quite unprecedented. That hasn't happened in the last 15 years. So I think this cycle is going to be different. Thirdly, Pearl split. We've all spoken about platinum, palladium, rhodium. It's the basket you mine. Different exposures to those metals will drive profitability. But also which reef, UG2 or Merensky, and that gives you the exposure to chrome, which of course Tharisa has a lot to benefit from that currently with the high price. And that obviously leads into the 4th driver, which is byproduct credits. So as you can see, those mines that are exposed to things like nickel and chrome are doing a lot better than others. But yeah, what they can do at the moment in terms of trying to curtail some of the losses, we've already seen it, cutting costs, cutting CapEx, certainly project CapEx. You will not see any more brownfields expansions, let alone greenfields projects. You will not see perhaps even sustaining CapEx continuing at the same rates. We've already seen some labor reduction, and so we've seen early shaft closures. So yeah, I think it's something that is not fully understood in the market, but these companies can't keep burning cash the way they are, and I think you may very well soon see some shaft closures, which hasn't been happened for some time.
Thank you. And I guess just a kind of observation of my own, looking beyond South Africa, we've obviously seen a big increase in nickel output from Indonesia and the Philippines. And of course, that's putting some pressure on primary nickel producers in other parts of the world, for example, in the Sudbury Basin in Canada. So there's certainly risks to byproduct PGM production from the sort of second derivative effect of the pressures on the nickel market. Henk, just returning to you and the kind of capital-intensive aspects of the PGM mining industry and the long lead times. If we see the prevailing market for PGM prices remaining low for the foreseeable future, and I guess, obviously there are some risks to automotive demand over the medium to longer term. Sorry, I'm going to start again here. You noted that mining is largely concentrated in 3 regions globally, South Africa, North America, and Russia. What are the key themes that we should be aware of within each of these geographies?
I think we've dealt already a lot with the South African situation. So maybe looking at North America, they are palladium-dependent mines in particular. Impala has already made the decision on North American palladium to essentially mine it out. They're going to shut the mine over the next 2 or 3 years. There was a comment by the CEO of Sibanye-Stillwater talking about the Stillwater mine having to be put on care and maintenance potentially. That could still happen as well. Again, a mine that's burning cash at quite a hectic rate and might need to take a pause, and they could, as a result, potentially put that mine on care and maintenance. That will, in a way, be a good signal for the palladium market, because what the palladium market does need is some of this production coming offline, and I think it will help the remaining miners. It's just somebody needs to take that first decision. I think Russia is a bit of a different situation. Because of the Ukraine war, Western equipment suppliers stopped supplying it with the equipment they needed to mine. There's been, as a result, a bit of a rehash of some of the projects, which will delay some of those projects coming to market. It will probably impact some of the base production as well. But importantly as well, quite a few of the ounces have shifted more to Asia because there was a bit of sanctioning of those palladium ounces in particular. We do think in time that there will be further growth in Russian output coming. It's unfortunately not at a time that this market needs further primary ounces, and it probably will put continued pressure on the palladium market as a result, and palladium in particular, because the palladium market, as I mentioned in my forecast as well, is particularly going to be impacted by a lot of recycling ounces coming to the market. So we see possibly still a short period of prices just above 1,000, but after that we think palladium longer term will trade below $1,000 an ounce, and that has quite big implications, I guess, for the economics for a lot of the mines in the industry.
I guess just to ask a quick sort of extension to that, at those sorts of prices, a lot of the palladium supply isn't necessarily that sustainable. So, do your price expectations kind of adjust as the supply reacts to those prices?
Yeah, you have to assume that that North American production will fall away over the next couple of years. We think the Russian production will be particularly robust because it's nickel and copper driven. We do think the South African supply base will come off. There's some mines that will shut down. There's the impact and I think that's the reality of mining. If you stop investing, they will start to mine out what is there. And particularly in an older industry where you have mature shafts blended with new shafts, blended with midlife shafts, if you do not replace the end-of-life shafts, you will shrink. And that is, I think, already baked into the system.
Thank you. And then, Michelle, I'm going to return to the question I tried to ask Henk before, but mining, obviously, as we've already discussed, is notoriously capital intensive with extremely long lead times. With the potential for lower for longer PGM prices and obviously some risk to automotive demand, how does that factor into Theresa's plans to invest in the greenfield Karo mine in Zimbabwe? And what are your confidence in the medium to longer term outlook and the investment decision there?
So I think it's a really pointed question, and there's been a lot of discussion today in terms of what the outlook looks like for supply-demand fundamentals. And certainly, as we all buy into the whole philosophy of the fact that PGMs are that critical metal that decarbonizes the future for us, on the one hand. On the other hand, I think both the discussion from Adrian and from Henk has showed that there will be a decline in mining in South Africa. We will see mining continue to go deeper. We will see it to be far more capital intensive. So then what are the options? And for us, being a junior miner, we're able, I suppose, to be a little bit more flexible and agile. And so we've assessed what happens in Zimbabwe. The Great Dyke is a well-understood geological area. So it presents an opportunity for shallow mining. It presents an opportunity for large-scale mining. Of course, Zimbabwe itself comes with its own challenges, but being used to, I suppose, mining and operating in African territories, it's something that we understand as a company. And so we believe that there is opportunity in Zimbabwe. We have slowed our project down just a little. We certainly haven't stopped it, but that really is paying heed and being a little cautious as we listen to some of the headwinds coming up. But having said that, and listening to the conversation today, there's no doubt in my mind that there has to be some supply coming from somewhere. So where is it going to come from? And I do believe that Zimbabwe will give us that opportunity to be able to position ourselves well as the PGM prices start to recover and ultimately as PGM supply is required.
Thank you. And perhaps just asking a small extension to that question. I mean, overall, how would you describe the operating environment in Zimbabwe? It obviously has its challenges, but on a holistic basis, is it easy, medium, difficult?
Yeah, in my opinion, it is easier in some contexts. Certainly, mining is simpler in Zimbabwe. I think the nature of the ore body lends itself to a less complicated mining method than that we have in South Africa. It's not as deep as what we have in South Africa. The people are highly educated and they're skilled workforce. The complexities that you have compared with the trade unions in South Africa and different regulatory challenges are very different in Zimbabwe. Having said that, we do have a structure and an environmental structure from a government point of view that is less mature than others and needs to move and move forward. But again, having said that, our sponsors today, Anglo, are producing really well in Zimbabwe. They're doing particularly well. Zimplats with Impala are doing particularly well. So I really do believe that there's opportunity in Zimbabwe.
Excellent, thank you. And Adrian, just returning to you, given the challenges the miners are facing from a cash flow perspective, in your view, how easy is it to shutter production and potentially restart it in the future? What are the barriers to exit and to re-entry?
So I think this is a commonly misunderstood aspect of PGM mining, particularly for foreign investors. It's very difficult to shutter a mine in South Africa. It's not like an oil tap. You can switch off and stop the flow. PGM mines have big operations, have significant amounts of infrastructure that needs to be maintained, whether you're running them or not. And so hence you have a high fixed cost base. Secondly, they have a large workforce. These are generally conventional mines as opposed to mechanized mines that use lower labor complements. Also, they support local communities. So in essence, the PGM miners in South Africa have a very important socio-economic contribution to society. So a decision to shutter a mine will not be taken lightly because of the economic, social, and political risks a producer faces. That said, I do think we are in a different regime. We're at a point where I think some companies won't be able to continue. We'll have to make some very hard decisions. It may not be in South Africa, it may be foreign shores, but ultimately, unless prices rise, production will have to be cut.
And if a company chooses to shut an operation, but let's say the environment improves in the future, how easy is it to necessarily reopen these mines from a technical perspective, in your view?
So, you've never actually, no mine has actually been closed in South Africa formally because the environmental liabilities are very big. A good example is like Harmony Gold that has shuttered many mines over the years, but what they actually do is put it on care and maintenance. So therein lies a fixed cost that sits with the company. You can actually look at it in the P&L. But ultimately, it's going to be expensive to restart these operations. Typically as well, with deep-level conventional mines, you tend to lose the infrastructure. So although you might put it on care and maintenance and you're just ventilating and keeping the pumps in good working order, you will lose face. In other words, you will lose your part of your reserve, and you might have to go and spend that capital all over again to reopen that up. So yeah, I think once you shutter a mine in this environment, it's going to be very difficult to reopen that.
Thank you. And I think that one of the key points there is really the fact that you can lose reserve and so sterilize a portion of your resource, which you may never be able to re-access again. Henk, I think you have sort of touched on a lot of the points in the next question already, but obviously the polymetallic nature of the ore bodies and the basket price aspect, with each of the PGMs having their own supply-demand fundamentals. Are there any actions that the miners can take strategically to try and address the differences in the supply-demand outlook for these different metals?
I guess there is a certain amount, but it's also limited by the nature of the ore bodies. In South Africa, there are differences between the north, the west, the east on the ratios, and one can look at making capital decisions that benefit the one ratio versus the other ratio. Not sure at the current cash burn if that's going to save a company necessarily, simply because of most mines or mining companies have a portfolio of assets, and spending more on asset number 1 instead of asset number 5 is not necessarily turning the dial sufficiently to actually make the economics work very differently. I do think that the fact that a lot of them are now recovering chrome, where previously that was thrown on the tailings heap, has made quite a difference to the economics, because it's a credit to your costs. Chrome prices are very strong at the moment, and a lot of them are re-looking at further projects and gaining some further chrome out of either the old tailings or existing tailings flows that haven't got a recovery system behind them. And that is going to give them some breathing space. Maybe also touching a bit on Adrian's last comment, what happened in a past long down cycle as well is that companies are starting to skimp on development. And that is one of the twists you could see, is that you develop less. It's essentially digging the tunnels, preparing for ore extraction. It's often a bit of a last-ditch attempt, because it's going to catch up with you one day. You lose mining flexibility. It's saving you money in the short term, but you're going to pay that back. And it also will translate that by the time a mine eventually closes, whoever wants to reopen it again will have to spend a lot of money up front developing, and a lot of time that it takes, because these tunnels, they blast 2 to 3 meters a day at lots of different places in a mine. You're spending a lot deeper pocket of capital before you restart the mines again, if that's the way that some of these mines will exit the industry or head towards closure.
So I guess what you're sort of summarizing what you're saying there in a way is, by reducing the amount of reserve development, you can sustain your guidance, but the risks of achieving that guidance effectively go up, or rather the risks of underperforming versus guidance go up.
Yeah, in mines, shutting mines down on that basis, the opening of those mines will be more economically challenging.
Thank you. Michelle, just coming back to you, and given that we've seen, or we are seeing, or at least entering a period where we're likely to see capital underinvestment and the potential for supply erosion, for the smaller operators in the space, does that present any opportunities in opening up access to downstream processing facilities for your concentrate and so on?
Yeah, there certainly are opportunities. Again, it's going to be that fight for capital and where you're going to put your capital. From our point of view, we certainly have spent time undertaking research and development in terms of our smelting capacity and looking at essentially how we would higher grade our PGM specifically. So there's opportunity, but it is capital intensive, and at these prices it wouldn't make a whole lot of sense. Having said that, as a junior miner, we've had support from the majors, and we've been able to place our PGM successfully with our peers and get good terms for it. So for the moment, it still makes sense, and that's what we continue to do.
Thank you. And then Adrian, just returning to you for my next question. when you speak to investors, how do you think investors are positioned in terms of their perspectives on the automotive industry and I suppose the pace of battery electrification and how that translates into their view of the PGMs as a result? And has that perspective changed at all over time?
It's changing as we speak, I think. If we speak to investors in South Africa, they generally underweight the sector on concerns of the financial performance and the fact that the basket price hasn't moved for almost 12 months. But I think it's starting to get positive. I think the key drivers for the positivity is the slowdown in EV penetration, and that is breathing new life into the ICE vehicle, including the hybrids. And in fact, in our analysis, we foresee growth in catalyzed vehicle demand up till to 2030. And that's very good for PGM demand. So we think the downside risks are very limited from the demand side of point of view. But also, investors, they're also quick to change their minds, right? And they always look for new reasons. But what I think is overlooked is the supply side. We've spoken about primary supply. We haven't seen shaft closures per se, but we have seen reductions in workforce, which is translating to lower production. For example, platinum is down 500,000 ounces over the last 5 years. We foresee another 20% reduction by 2030. And interestingly, secondary supply is also very weak, not very commonly spoken of, which is unusual because the producers are being lobbied by the investors to shutter operations, to improve pricing. But what they've overseen, I think, is the decline in recycling, which declined about 15 to 20% last year. And we foresee another 20% this year. And to put that in perspective, at the peak palladium secondary supply, 30% came from autocat recycling. So, yeah, I think it's quite positive, the outlook from that point of view, from both demand and supply. But we're in a surplus market for this year, and we were looking for those green flags. We haven't seen them yet, but I think it will turn.
Thank you. And then just running through a final round of questions for each of you, and I'm going to start with you, Henk. Obviously, we've seen recent supply-demand dislocations with palladium and rhodium that have resulted in some pretty significant price volatility. Looking ahead with the kind of growth of the hydrogen economy, albeit off a small base today, could we see similar dislocations for platinum and iridium that result in sort of price action being sort of somewhat aggressive for those commodities?
I think starting with iridium, definitely, it's a much smaller market. It's essentially 250,000 ounces a year. A lot of that metal is already pre-assigned to customers, so the actual free float in iridium is so small. So if new consumers step up and start buying in volume, and you can see it in the trade stats and the pricing stats, it's a very sticky price. And it has had some very violent bursts, and that can easily happen in iridium as well. It's not necessarily good because we rather see stable prices, predictable prices than super volatile prices. But if there's one metal that could have a rhodium-like spike, it probably will be iridium. I think the idea of therefore minimizing your metal use or being very efficient in using it is definitely wise as well for any manufacturer. Secondly, on platinum market has always been, in the last few years, and there was a slide shown by you as well, of the big stocks that are needing to be worked down. And I think we're moving closer, obviously, to the point that will start to then translate in higher prices. In fact, if the South African platinum industry wants to survive, it's probably platinum that has to start moving, because there's two escape valves. It's either the currency that needs to crack. With the new government that has come in, which is a lot more business-friendly government, it's unlikely that the rand is going to crack unless something dramatic will happen. So it probably will be the platinum price. And if you look historically as well, it's often the industry got saved by the dollar prices moving because it is such an important contributor to the overall platinum supply. So it will probably be the platinum side that will see the upside. It is because it's such a much more liquid market, we don't expect necessarily these violent moves. It's probably more a steady ramp up as we go along, because we do see hydrogen impacting demand, but it's going to be a much slower and steadier ramp up than like a sudden spike in demand coming up, driving or doubling prices. Then that's probably attractive from a investor perspective as well, that it's a steady rise rather than a spiky rise for platinum.
Thank you. So just paraphrasing here, I think you said iridium's the next rhodium. Is that right?
It could well be, yeah.
Thanks. Michelle, just discussing the theme of different supply and demand dynamics across the different suites of metals, how does Teresa engage with end users of its metals to try and get better alignment in terms of supply and demand with their needs and your output?
So we've always had a mine-to-market philosophy and strategy. So right from the very beginning, we actually sold all of our chrome concentrates directly into our customers in China, and we established a strong infrastructure and market relationships. The PGMs were a little bit different because we didn't have our own smelting and refining capacity, so we established strong relationships with our platinum producers, and they take our offtake. Having said that, it's always been our view that we want to control the metal ultimately that we take to market, so we would be looking at furthering that as far as the PGMs go. But certainly within chrome, I think it's paid off well for us to have that mine-to-market strategy. I think had we given that away years ago and not had the margin that you have in that particular market, it would have made a material difference in our business. So certainly mine-to-market strategy works well for us.
Wonderful, thank you. And then Adrian, just finishing off with yourself, a bit of a sort of somewhat tricky question really in some regards, but obviously we've had the elections in South Africa recently, the formation of the Government of National Unity. Firstly, what's Standard Bank's sort of view of that in terms of what the implications might be for the mining industry as a whole, and perhaps more specifically for the platinum mining industry? And we haven't really talked much about the rand so far. We've talked about the commodity prices. How do you feel that is likely to influence the rand and therefore flow through into the cost base for the producers?
Yeah, so that's a loaded question. So let's start with, I think, firstly, the election was quite peaceful, and I think that bodes well for future negotiations between party members. As you know, it's a government of national unity, and it's a partnership. But also, if we look at the behavior of the rand, it was also sending some positive signals that the market, it was quite market friendly. From Standard Bank's perspective, we think it's net positive. What's the outcome, and positive for SA business climate, and we don't think policy will change much, and we think relations with China will continue to be maintained on a good path. In terms of the cabinet that was announced by Cyril Ramaphosa, it was positive, I think, in some aspects of his cabinet, particularly in energy, electricity, trade, transport, and police. So, yeah, I think from that perspective, we could see the rand going to 17, but perhaps even 16, so who knows. In terms of costs, obviously, when you're reporting in dollars, that's not going to look so good, and relative to a dollar income, it's not going to look so great. But certainly, these are mining companies that import a lot of their goods. That includes consumables and such as stainless steel. But also a large portion of their cost base is actually rand-based, so it's not going to have a huge influence. I think in terms of the PGM industry as a beneficiary of this outcome, look, I think we would like to see more reform. I think it needs to become a bit more business friendly. But at the moment, I think it's really about surviving, managing the low basket price, and of course that's quite sensitive to the unions particularly.
Thank you, and I guess just an observation from me on the rand. In the past, we used to see a strong correlation between the rand and PGM prices, where stronger rand, you'd get stronger US dollar prices, and that relationship really seems to have broken down since about 2019. So even with the rand strengthening, we're not seeing the benefit flow through on the other side.
Yeah, look, I think South Africa is a commodity-based economy, so weakness in the rand, you'll have a response typically. We know it works in the other direction, certainly. When platinum prices fall, the rand tends to weaken. It's a natural circuit breaker for any commodity-based economy. So it certainly works I would say works as a good floor to the platinum price.
Wonderful, thank you. Well, before thanking our panelists for their fine contributions, I'll just sort of wrap things up, I think, and summarize the discussion so far. So the key point really is that the current PGM prices are fundamentally unsustainable in terms of continuing to support supply. So at current prices, there are material risks to the output of PGMs from South Africa, arguably some of that byproduct PGM production from nickel operations as well. And so, it's just something that's worth bearing in mind when considering the security of supply, particularly if one is an end user of these strategically important minerals. So with that, I'll say thank you very much, all of you. It's been a great discussion, and thank you for your participation.